Hello everyone, welcome to my channel. My name is Vicky and today I will be talking about ATT. A specific chapter that I have chosen today is capital gain tax, which is one of the most important and significant chapters if in case you're preparing for paper one, personal taxation. And hopefully I can go through all details and sort of introduce you whole subject and how to go through the questions and what you can be expecting during exam. So what is capital gain tax? So basically when a person disposes a capital asset on a profit and they have to end up paying for capital gain tax. This is I just want to highlight that I live in UK, so I will be assuming that you are preparing for UK tax. If you're from abroad, please do have a check on your taxation regulations and make sure that you are preparing the right exam. However, due to the fact that I'm living in UK and in fact that ATT is UK qualification, so I will be going through UK tax regulations and sort of give you an introduction of what is capital tax gain tax. I beg your pardon, and how to deal with it, and also what sort of questions you'll be expecting to answer on your exams. Typically, on ATT exams, you've given 3 hours long exam, and you do have an access to um, study guides and also like the books that you can also have a look into tax law books. However, you are expected to know all the formulas that we're applying. So basically, the company what the company that pays called corporation tax, and this is from the gains that the company has made throughout the sale, and but the person pays the capital gain tax. So the fact is that we are looking at personal taxation, paper one, so most likely you will be working with capital gain tax. I just want to highlight that non-UK residents do not pay CGT. It's only the UK residents this law is applied to. Sorry, when you dispose an asset, what is the disposing asset? Basically, when you're selling or gifting or giving away an asset, let's say your house or a car or anything that is counted as an asset, and you are either having a loss or a gain in return, which will automatically qualify as profit or loss in your accounting process. So this is what we call disposing an asset. In mind, there are some exemptions on CGT, so not everything that we are selling and we're making profit on has to be applied these CGT rules on. So, for example, if we are selling any moving vehicles, such as cars, vans, or lorries, and we've made a profit, we do not pay any CGT on it because it's exempt. This also applies to any wasting chattels or gilts or any profit that has been made on ISA accounts, as well as any situations such as any transfers or money has been dealt and made profit on between husband and wife. I just want to give you a tax gain allowance for this year. I'm talking about 2023-24 is currently £12,300. But to £6,000. What does it mean? Basically, anything that individual makes as a gain, profit, of an asset that has been sold, the value of a 6,000 will be annually required to pay CGT. Now I'm going to throw in some questions that I have come across while I was doing my paper 1 exam, and I believe this will be helpful for you to calculate, and also to have an idea of how to handle the questions. So one of the basic way of calculating capital tax gain, and one of the basic questions that you will come across with during your exam will be, for example, a blah blah Charlie has been selling a statue of let's say the cost of 8,500, but then he sold shares of 12,600. So how to calculate CGT out of that and apply the annual exemption of annual exemption amount. So it's pretty simple. All we have to do is just adding up the profit that we've made. Obviously, if Charlie has sold his statue and he got a gain of 8,500, we're just simply adding it on to the shares that it's been selling, and the profit that is made, 12,600, that will obviously give us £21,100, and we know that our annual exemption for this year is £12,300. So all we have to do is just take out the annual exemption fees, and whatever we have been left with will be the taxable gain. But then you will come across with the questions where the second part will become more complicated. For example, like we said earlier, Charlie has sold his statue and he made a profit, as well as he's selling his shares. And we calculated that his taxable gain was 8,800. But the second part becomes more challenging when he has a salary that has been added on, which is, let's say, 36,000 a year. So how to calculate this? Always remember that when we are talking about two different questions in one question, and we are talking about the salary, we need to remember we have a personal allowance that every person is entitled in UK, and currently the personal allowance for the year of 23-24 is £12,570. All we have to do is just take out that salary, £36,000 that we were talking about, and take out that less of £12,570 to give us the taxable income the person is entitled. Is when we identify what taxable rate the person is entitled to. As we know, we have three rates that we need to look at. It's the basic rate, the higher rate, and additional rate. Current basic rate in UK is for 2023 and 24 is £37,700. So what we have to do is we are taking this 37,700 and we are deducting the personal taxable income, I beg your pardon, that we've calculated for the individual, and after that we have to identify which tax rate we need to apply on this individual. Once we have taken the taxable income from basic rate, what we get, the leftover, is called unused amount, and this unused amount will be deducted 10%. Remember that a CGT tax depends on the level of individual's income, on a taxable income, and also the nature of the asset we have been selling and making profit. Generally, the rate is 10% applied on if they do not exceed unused basic rate. However, if they are above the basic rate, 20% will be applied. So the best way remembering it is just basically whatever is £37,700 will be the basic rate, and after taking that, applying the 10% tax rate, whatever is left over will be 20%, and any gains over unused amount will be charged 20%. Like that, this is only based on English taxation, because as we know, the Welsh and Scottish taxation is slightly different. So if you're studying for tax, you're aware of the situation. So the next step would be calculating the capital gain on the sale of a house. So as I mentioned earlier, our tax rate raises to 18 to 28% if we're selling, making profit on a house. So let's give an example. For example, Dave bought a house of costing him £120,000, and then he's got the legal fees that he's paid around £5,000, and then he decides to sell the house and gains a profit. So his proceeds will be 200,000 on sale, and also he has ended up paying for estate agent costs, which cost him £4,000 during sale, and also Dave is a higher rate taxpayer, and this is just a disposal, and we need to calculate how we're going to deal with his capital gain. But remember that he's a higher rate taxpayer, so we have to be very careful every sentence that we read on exam questions, because they do have effect on how we will be calculating the question. So as we said, his gross profit was 200,000, I beg your pardon, and then he has selling costs that cost him £4,000 for the agent, and his net proceed will be £196,000. And then he's got also the cost of acquisitions, which were the purchase of his first purchase, and also his legal fees that he's paid during his first purchase of a house. So obviously, before we calculate the capital gain tax that we have to pay, we need to deduct all these costs. So whatever we've been left with will be his the capital gain. So in the case of Dave, like we mentioned, he's had net proceed of 196,000, and then we have his costs taken out as well. So he will be entitled to pay for capital gain of £71,000. There is a pro forma for capital gain tax, and I will be putting the pro forma above, so hopefully that will be helpful for you during your exam questions. So our pro forma is quite simple. So we have a gross sales sale proceeds that we have gained from sales, and then we need to deduct the selling costs, like I mentioned earlier, and then we will end up with the net sale proceeds, and whatever we've left with net sale proceeds, we need to deduct the costs, the acquisition costs, and enhancement expenditure. So after all, we will end up with the gain, and the summary for the CGT will be that we need to decide whether the CGT is entitled to be eligible for something called BADR, and or it's not entitled to be for BADR, or is it a residential property. BADR stands for business asset disposal relief. So this is a relief that government has introduced in order to help individuals with tax. But also you must know that this is only for the individuals, not the companies. So it's only available for the people who have their own business, rather than or the shares in the company, rather than applying it to the company. This is just to help people to pay less tax when they're making profit. There is no limit of how many times you can claim for BADR. However, it's up until £1 million. So if you have an asset over £1 million, you will not be able to be eligible for BADR. So that's all from me for today. I hope you found this video quite useful and helpful throughout your exams. If you do like my videos about paper 1 and paper 2 ATT, please do subscribe to my channel and comment down below your questions and your concerns. If there is anything I can explain more in depth and help you out, hopefully maybe we could go through the questions together. And I would be very glad if you just subscribe to my channel and just be part of my daily shared videos, and put likes if you really like it. So thank you so much for watching, and I'll see you next time.